Welcome to Make Your Money Matter. I'm your host, Brad Barrett. I'm also a managing director and partner here at One Capital Management. And today I want to talk about something that's come up recently in our practice, in our review meetings, as well as some comments here on our channel. And really, for many of us, it's like the age-old question, which is the question of when is the right time to jump in to the markets, especially with the debt ceiling going on, volatility we've seen all year. I think it's a great time to talk about this. But before we get into it, make sure to smash that subscribe button and hit the notification bell so you don't miss a single episode. All right, let's get into it here. So I want to share this very simply by giving you an analogy. I've been surfing most of my life, and anytime you go to certain surf spots, there's a time when you have to jump off the rock and really time the waves and the tide. And I bring this up because I think it's a good analogy, right? Because a lot of surfers, they'll see the water at the bottom of the cliff, that they rise and fall with the currents when you're standing on the rock. And when the tide is out, meaning it's low, right? It's too shallow. And a lot of times I see surfers, they'll jump off when they see the water come to its crest before it goes back out. Why? Because they feel comfortable. They feel like, okay, I can land on this soft bit, but by the time they jump, the tide is already back out and now the water is too shallow. What I want to share with our clients here at One Capital Management watching, as well as you viewers and listeners, is making sure that we actually want to time and jump the market when things are down, so when it rises back up, we have a softer landing. We don't just want to go because it's cushiony and everything's going well and you want to get in. You want to kind of go through everything as it regards to both sides of the market. But there is some time involved here, and it's a statement I've said for a long time, right? It's not about timing the market, it's about time in the market. So have you ever told yourself, I'll get back into the market when it comes back up, or I'll wait to see what happens? So let me say something loud and clear here on this. Nobody ever got rich or grew their wealth by sitting on the sidelines. And look, there's plenty of reasons to sell and be on the sidelines. I get it. I mean, you can talk about bank failures this year. You can talk about rate hikes. You can talk about supply chain issues, or in crises in that regard. You can talk about a pandemic. You can even talk about 2018's trade wars or 2015 and 2016 Brexit. You can go back to 2013's government shutdown. So we're seeing a lot of what happened 10 years ago. You can go back to 08 and 01, and we can talk about all this for a long time. Mind you, you can make an excuse is what I'm saying, and even a case for selling and sitting on the sidelines, but you're never gonna grow your wealth by staying there. Let me give you an example of something I talk about constantly around emotional investing. This fear and risk inside you has a lot to do with emotions more than rationale. And it's like during bear markets or volatility, you're like, I need to get out before I lose everything. And then it's ironic because during bull markets, you're like, I need to get in before I miss out on further gains. The best investors I've ever seen around are always growing and building in an asset, especially when they're quote unquote on sale. Now I made the relationship to sometimes when I go surfing, for example, I have to jump off certain rocks, and most people think they want to wait till it's nice and high, so when they jump, it's a soft landing. But if you know anything about oceans, tides go up and down, and it's the same in investing. So feeling comfortable when things are up, we should have that same discipline and mentality when things are down. So I'm really basing to answer this question on discipline. I mean, that's where a good advisor comes in, and quite frankly, to help you through all this. And I think it's really important because if you don't do those things during those kinds of years, you start missing out on opportunities. I was playing Monopoly recently with my 7-year-old Brooks, and actually my 5-year-old Kate was playing with us too. And we play this often now because my kids are finally at an age where they can understand it. And it was a game I realized I always loved as a kid. And I realized the other night in Monopoly, what it taught me. It taught me basically, and I was almost explaining this to my 7-year-old, that if you don't take risks at all, you'll end up paying rent to someone who did. So building a discipline at some point in your life and understanding that the opportunities that come during volatile times should be the same opportunities in the same way you think about it during good times or bull markets. And it's been said before that, bear markets are where the money is made. So make sure you talk with your advisor and really look at yourself if you're doing your own investing and know where you're going with your money, because ultimately the destination is going to give you the clear route to take. As you hear me say often, the planning environment that you put around yourself will help you get to the ultimate destination you have for your money, which is either becoming financially free, having financial freedom in general, a good retirement, or anything that relates to a distribution rate and having income when you choose to be retired or be financially free. But remember this, making money is an action. Keeping money is what I'll call a behavior, but growing your money is knowledge, is wisdom. And all of this is wrapped up into discipline. So keeping those core things in line with your attitude as you go into both a bull market and a bear market has a lot to do with your overall outcome with your money. Hey, hope you enjoyed that show today. If you did, make sure to subscribe to our channel so you don't miss a single episode. And always remember to make your money matter.